Welcome to Common Sense Investing. My name is Cameron, and today I continue my journey in trying to find the next 10x penny stock. As always, I look forward to giving you introductions to good companies that also have the potential of being good stocks. Today I get to introduce and discuss some of the rewards and the risks of investing in one stock that can be considered slow-moving, boring, cheap, maybe even a little bit beat up by the market, and another one that just as of last month people were willing to give up on but still has significant opportunity. Do not forget, I'm not a financial advisor. This is not financial advice. This is simply a quick introduction to these two companies. NeuPath, Center for Pain and Spine. Pain is sometimes invisible, but you don't have to be. They have operations in Ontario and Alberta and hopefully growing. NeuPath is a leader in chronic pain management. We are dedicated to empowering and improving the lives of people with pain. They operate clinics, brick and mortar clinics with actual doctors. This is not a SaaS company, but it's still exciting, at least to me. Historically, this company has been improving, with the darker lines being 2022 and the lighter lines being 2023. They have seen an increase in cash, a decrease in debt, a decrease in net debt, and an increase in adjusted EBITDA, with revenues up 6% from 2022 to 2023 and adjusted EBITDA up 41%. 34% of the shares are owned by Bloom Burton, a Canadian-based investment firm. Only 2% is owned by the board and management, 56 million voting common shares. When I look at their recent earnings from November 14, 2024, record revenue of $18.9 million, that is up 11% on the quarter, 10% year over year. Adjusted EBITDA was up 30%, 22% year over year. Capacity is improving. The company keeps growing. They're looking at adding more locations. The company had $2.9 million in cash and cash equivalents, debt of only $6 million. So it's improving, but still a little bit more debt than you would like to see for this company. But I mean, pretty good growth, top line growth, 10 to 11%, bottom line growth, 22 to 30%. What does valuation look like? Cheaper and cheaper and cheaper and cheaper. People are just not noticing this stock, right? So every quarter they seem to show improvement, and every time I look, they just keep getting cheaper. Price EV over EBITDA is cheaper, price to book is cheaper, right? Market cap keeps dropping or staying the same. This company just isn't being discovered by investors at all. I think that's unfortunate, and if they get a valuation correction, you could see share price go up, because these numbers are pretty good to improving at the very least. Valuation is not improving, it's going down as the company improves, and because of that, share price is just stagnant. But I think at some point, if the company can continue with numbers like these, congratulations to NeuPath, by the way, and announce continued growth with more locations, hopefully they can get a valuation recorrection, maybe even a little bit to the side of growth, which they are getting now, and it won't be so beat up moving forward. So good enough to get on my watch list to see if other investors start looking at NeuPath. The next one up is definitely not boring. This is a drama-filled, or at least was a drama-filled, exciting stock that I'm talking about here. NowVertical. We untangle complex data challenges. What does that mean? Well, I've seen a few of these companies now where they take complex organizations, all their data, and they use AI to deliver something that the company can do with all this data that's normally just sitting there, sometimes doing nothing for some of these large companies. So they take data and transform it into business value, giving actionable outcomes. Typically, what I've seen is that these companies either figure out how to do it well and they succeed, or they don't and they fail, obviously, right? The nice thing with NowVertical Group is they have some pretty big clients. So it's at least a somewhat proven technology with clients like Disney, The Economist, right? There's a little bit of trust in here. There's also diversity where they're not relying on 2 or 3 big clients. There has been improvement with their product over the years. However, what was not improving was the company. They dug themselves a pretty big hole here with significant liabilities. They are now going through restructuring to try to reduce that. This company is a turnaround story. Part of that turnaround story is NowVertical Group has a new CEO effective as of January 2024, and they made some changes. Instead of being a complicated AI business, they wanted to focus on one brand, one business, very simple company with pillars of action on strategic growth opportunities And yes, this is my chance to flex a little bit as well as do a shameless plug, because I do have a Patreon Discord. In the Discord, we introduce new stocks, research them, chat about them. We just have fantastic discussions about different stocks. Yes, I own NowVertical Group. I actually bought in the Discord at 16 cents. They went down to 8 cents Canadian. I bought more. I had a dollar cost average of 12 cents. Why did I do that? Well, don't let anybody tell you otherwise. I mean, NowVertical Group still has a lot of risk. There's also a lot of potential there. It is still a high risk stock. What I'm doing is betting on their new CEO. So in the Discord, I basically listed out in the past 7 months everything that their new CEO, Sandeep, has been doing since taking over NowVertical Group. And I think it's been impressive, especially things like hiring independent directors are a significant move up from where NowVertical Group was. But if instead of being recognized for their improvement, share price kept going down, 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 all the way here to when I bought at 8 cents. The recent share price bump is pretty minor compared to where this company was or where people thought it should be in the past. Can they get there again? Well, Q2 saw improved numbers. Their Q2 saw revenue growth of 2%, which isn't a lot, but they stopped going down in revenue. Their operations saw significant improvements. So in Q2, there was hope for NowVertical Group. But the recent quarter in Q3 is when this company finally shows people the light of day at the end of a dark tunnel, because they're starting to see some revenue growth. The EBITDA continues to move up. Operating income continues to move up significantly. And you start to see a company that looks like this with annualized revenue of 43 million, annualized EBITDA of 8 million. And that 43 million of revenue is still on a market cap of $22 million at the time of recording this video, which is still pretty low, right? Price to sales of 0.28, EV over EBITDA of 6.83. But I mean, yeah, they still got a lot of debt you need to go take a look at. This company is still high risk in my opinion. But if NowVertical Group can figure it out, how high can their share price go? This company was left for dead by investors. However, Q3 was their first clean quarter since their divestitures. And I mean, the CEO in the past 7 months just making great decision after great decision. Investors are starting to recognize the potential of NowVertical Group. So congratulations to NowVertical Group. I'm very interested in seeing what happens in the future with NeuPath. What do you think? Let me know down below in the comments. Which one of these stocks do you prefer? Do you prefer the slow, boring company moving its way up, hoping to get noticed by investors? Or do you prefer the drama-filled turnaround story with a CEO making good decisions? You've been watching Common Sense Investing. My name is Cameron. Thank you for your time.